For this webinar, we will assume that you are comfortable enough with the basic principles of technical analysis. I assume that you are comfortable with the principle behind support, resistance, trend line, and all about the concept of market psychology. So now you're ready to take the next step, which is the study of the chart pattern. But of course, if there is any doubt about technical analysis concept, you can ask me your question, preferably at the end of this presentation, and I will do my best to give you a detailed answer. So let's first let me briefly introduce myself. My name is Nicolas Suiffet. I'm a technical analyst in charge of the European stock markets and equity indices at Trading Central, and I'm based in Paris. I graduated from Paris Dauphine University with a master's in financial research, and I'm a member of the Society of Technical Analysts in London. Prior joining Trading Central, I served as a market economist for Exane BNP, which is a French equity broker, and also for Société Générale, a French bank, in the global macro department strategy. So my job here is to provide advice to institutional and private banks for their trading strategies, from intraday to swing trading and also long-term investment. So now let's get into the swing of things. First of all, what are price patterns? Price patterns are picture or formation which appear on price charts and that are predictive value. There are two types of pattern, the reversal pattern and the continuation pattern. So we will discuss about the reversal pattern in the first part, you can see in this part. So we'll speak about the classical head and shoulders pattern, double top, double bottom, and also the rising falling wedge pattern if we have time. And in a second part, we will speak about the continuation trend patterns such as a triangle, flag, or pennant. So for each pattern, we will discuss how to trade them and see how it can help you to manage risk. So we will speak about money management and risk reward, because we think that technical analysis and especially chart pattern can help you to improve your money management and your risk reward on the market. So let's take a close look now at what is probably the best known of all major reversal pattern, the head and shoulders pattern. So I will spend more time on this pattern because I think it's very important, and most of the other reversal pattern are just variations of the head and shoulders. So we can move more quickly. So we can spend more time on the head and shoulders pattern. So a head and shoulders formation consists of a left shoulder, as you can see on this chart, a left shoulder, a head, and a right shoulder, and a line drawn as a neckline. This line. A head and shoulders pattern appears in a bullish trend, and then you can expect a reversal downtrend when the pattern is validated. On the contrary, an inverted head and shoulders pattern appears in a bearish trend, and then you can anticipate a reversal uptrend when the pattern is validated. So this is this example. So you can see the head and shoulders pattern on this chart, and on the bottom chart, this is an inverted head and shoulders pattern. So for the head and shoulders pattern, you can expect a reversal downtrend And for the inverted head and shoulders pattern, you can expect, thanks to the validation of the pattern, a reversal uptrend. So let's see what happens here in a bit more in details. So you can see a bullish trend. So if we take the example of the head and shoulders pattern, so on this chart, you can see a previous bullish trend, and the left shoulder is formed at the end of an extensive move during which volume is high. We cannot see volume on this chart, but I will explain on the next slide. We will speak about the volume in details. So on these charts we cannot see volume, but the left shoulder is formed with high volume. After the peak of the left shoulder is formed, there is a consolidation move which generally occurs in low volume. So this is this consolidation phase between this peak and this low. So this consolidation move generally occurs on low volume. Then the prices rally up to form the head, so right there, with normal or EV volume. The right shoulder is formed when prices move up again but remains below the central peak called the head and fall down again. So it remains below this level and fall down again. Volume is lesser in the right shoulder formation compared to the left shoulder and the head formation. Then there is a flat trend line can be drawn under the last two lows. So under these two lows you can draw the trend line, which is called the neckline. This line has generally a slight upward slope. Sometimes it's horizontal, but generally it's a slight upward slope. I think you have to be careful not to draw a slight downward slope. If you want to be sure that your head and shoulder is valid, I think it's a bit risky if you can draw a downward slope for your neckline. I think it's dangerous. I think maybe it means that your pattern is not cannot be trusted. So be careful. For the neckline, it has to be a slight upward slope or sometimes horizontal, but you cannot see a downward slope for the neckline and the head and shoulders pattern. So sometimes very interesting is the first thing very important I would like you to keep in mind is that the existence of a prior major trend is an important prerequisite for any reversal pattern. So prior up or downtrend. So indeed, a market must have something to reverse. Very often, I can discuss with investors who tell me, hey, have a look at this head and shoulders pattern, it's very interesting, blah, blah, blah. But there is no prior bullish trend or bearish trend. So that just don't make any sense. So be careful if there is no prior bullish or bearish trend. So for the head and shoulders, you have a bullish trend, prior bullish trend, and for the inverted, you have a prior bearish trend. So be careful. If there is no prior bullish or bearish trend, the reversal pattern cannot be trusted. And whatever the patterns, it can be head and shoulders, or double top, or double bottom, even a rising or falling wedge pattern. It's the same rule. You have to see prior up or down trend because market has something to reverse. So three rules to validate the pattern. The two shoulders should have similar amplitude. So you can see the left shoulder on this chart should have approximately the same height than the right shoulder. You cannot see a right shoulder just right there and the left shoulder right there. So you have to see similar amplitude between the two shoulders. And you have to see balance between the head and the two shoulders in time and amplitude. So if it takes, for example, 2 weeks to draw on the left shoulder, it should take approximately 2 weeks to draw on the right shoulder. Of course, we can see a small difference, but you have to see approximately the same. It could take the same time approximately to draw the left and the right shoulder, and you have to see similar amplitude. And regarding the neckline, as I explained, horizontal neckline or with a slight slope. To be honest, I do prefer when there is a slight upward slope. But be careful, if you see a downward slope, it means that the pattern cannot be trusted. So be careful about this. Okay, so let's speak now about the volume a little bit. So just to see, you can see on this chart, this is again head and shoulders, but you can see volume and what happened on volume. So you can see the bullish uptrend with the bullish trend line. So you can see that on the point A, you can see very high volume. Volume are increasing. We can see high volume on the point A. Then on the consolidation, volume are lower, which is quite normal. But on the peak, on the head, when the prices are shaping the head, we can see lower volume than on the previous point, on point A. So it means in the head of a technical analyst, it means be careful, because prices are making new high, but volume are lower than on the previous peak on the point A, which was the left shoulder. So be careful. And then you can see that on the point when prices are breaking below the trend line, so the neckline, so when prices validate the pattern, we can see a huge increase in volume. So this is another very interesting signal, and it means that you can trust the pattern, and then you can say at this time, okay, the pattern is validated. I've got the bearish signal for head and shoulders pattern. So volume play an important confirming role of the patterns. In times of doubt, a study of the volume pattern can be the deciding factor as to whether or not the pattern can be trusted. So keep in mind that you have to check volume when you want to see if the pattern is validated, if you can trust the pattern. Just don't look at the chart and say, okay, I can see approximately a left shoulder, a head, and a right shoulder. Don't forget to check volume when you can check volume. Of course, on the Forex market, you can't. So on the Forex market, you can forget, but if you are on the stock market, don't forget to check volumes. So let's maybe review. Let's review before talking about money management and risk reward. Let's review the basic ingredients for head and shoulders: a prior uptrend, a left shoulders on heavier volume, so on point A, a left shoulder on heavier volume followed by a corrective dip to point B, a rally into new highs but on lighter volume, point C, this is very important, lighter volume, a decline that moves below the previous peak, so the point D is below the point A, and approaches the previous reaction low, so this is the point D, a third rally to point E on light volume that fails to reach the top of the head, so this is the point E, and a close below the neckline. And you can say that the pattern is validated when prices break below the neckline. Very often a return move, we call pullback, a return move will often occur back to the neckline, so point G. And this is very important to keep in mind regarding your risk management and the way to do trading and the way to set up your trading plans. It's important to keep in mind this kind of pullback to avoid to be stopped out at the top of the market. So that's why I mentioned this kind of pullback, which happens very, very often. So be careful. We can see a pullback towards the neckline, and of course, it's not always perfect. So prices very often don't stop just on the trend line, but sometimes we can go a little bit higher. So it could be very frustrating to be stopped out at the top of the market on the pullback. So keep in mind that you can see this kind of pullback when a pattern, the head and shoulders or double top, a double bottom pattern is validated. So let's speak about now money management and risk reward, how to trade head and shoulders pattern. So the stop loss has to be set. Sorry, just right there. So just at the head at the top of the right shoulder. So you can avoid this kind of thing, this kind of pullback towards the neckline. And as I explained, it could be very frustrating. If you put your stop loss on the neckline, you can be stopped out if a price return move towards the neckline can stop out. So you can be stopped out thanks to this pullback. So it's better, according to have a better money management, to put your stop loss above the right shoulder. So this is the dotted line in green. So just right there. So be careful about this. Regarding the price, regarding the targets of the pattern, of the price pattern, that's very useful, price pattern, because most of the price patterns have also measuring techniques that helps the analyst to determine a minimum price objective. So so the price patterns are very helpful in assisting the trader to determine his or her risk-reward ratio. So for example, you can open a short position when you validate the pattern. If you just take the example of the head and shoulders, you can open the position when prices break below the neckline with a stop loss above the right shoulder. And what would be the target? The target would be, the first target could be the right shoulder's potential. So you can see the height of the right shoulder can be reported from the validation of the trend line, and you can find your first target on which you can take half profit. So this is the first dotted red line. And the theoretical target of the pattern is the vertical distance from the head to the neckline, projected downward from the breaking of the neckline. So this is again the distance between from the head of the neckline, the distance, the vertical distance from the head from the head to the neckline, projected downward from the breaking the neckline. And so you can find your second target, and you can close your position when prices have reached this target. So thanks to the head and shoulders pattern, you can very easily set up a trading plan. So find a reversal trend signal thanks to the validation of the pattern, and then set up your trading plan thanks to the right shoulder, thanks to the theoretical target of the pattern. So we can see just an example. This is the CAC 40. So you can see on this chart a very interesting example. It was very perfect. It was in 2007-8. So when we had a huge reversal downtrend on the market. So it was the top of the market before the crisis. before we see the huge bullish acceleration, you can see that on the French market, prices have validated a classical head and shoulders pattern. So you've got the left shoulders, you've got the head, you've got the right shoulders. You can see that we have similar amplitude. The pattern is balanced. The neckline is perfect with a slight upward slope. And you can see the validation of the pattern. It's too bad we don't have volume on this chart, but I've got another example with volume. So what would be the target? You can see the measure move target of the pattern, as I explained, the vertical distance from the head to the neckline, projected downward from the breaking of the neckline. So you can see the target of the pattern. And what happened, that's very interesting to see, that we saw some technical rebound after prices reached the theoretical target of the pattern. We can see some technical rebound. So it doesn't mean when prices have reached the theoretical target of the pattern, it doesn't mean that the trend is over. It just means that it encourages investors to take profit. So we can imagine that some people took profit around this area because it was the measure move target of the pattern. So we saw a technical rebound before prices resume their downtrend and fall down again dramatically. It was the crisis. But you can see that head and shoulders pattern could be a very interesting advance signal for reversal downtrend. And you can try to take advantage of this pattern to trade on the market, or at least to close your position. For example, you could be bullish on the CAC 40 from 2005. Okay, this is bullish, this is bullish. But if you see, you can identify such a pattern, you can say, okay, now it's time to close my position, my long position, and maybe to open short position if you can do this, if you want to do this. So just an example with volume. This is another reversal pattern, another head and shoulders pattern, sorry. So you can see the huge upward trend. Keep in mind, you have to see huge upward trend if you want to identify a reversal downtrend. So the validation was great with a huge pullback. So you can see that the pullback was higher than the neckline. That's why I was explaining that you have to put your stop loss just here above the right shoulder and not on the trend line. Because if you, on this example, if you have put your stop loss on the neckline just right there, you would have been stopped out just right there at the top of the market. So it would have been very frustrating for you. So that's why it's better, even if you take more risk, it's better to put your stop loss above the right shoulder. And then you can see on this chart, what I wanted to show you is the volume. So you can see on the left shoulder, very high volume. Then on the head, you can see low volume are decreasing dramatically. So that's a clear warning signal. And on the validation of the pattern, you can see increasing volume. So that's perfect. You can say, okay, I've got my bearish signal on the market, on this stock. It was a French stock, Pernod Ricard. Okay, so that was for the end head shoulders pattern. Now let's talk about the other reversal pattern, double top and double bottom. Just right there. The double top. So you can see on the upper chart. Sorry, I got the arrows. On the upper chart, you can see a double bottom pattern, and on this chart, you can see the double top pattern. So the double top pattern, this pattern has two peaks at about the same level, as you can see, there and there. And the pattern is validated when the middle throw is broken on a closing basis. So when this point is broken on a closing basis, be careful about spike. So you have to wait for a closing price. If you can identify the pattern on a daily chart, you have to wait on a daily bar chart. You have to wait a daily close below the neckline of the pattern. If it's a weekly chart, you have to wait a weekly close below the neckline of the pattern, etc. And as for the end and shoulders, a return move back to the lower line is not unusual from the breakdown point, so we can see what we call, again, some pullback toward the neckline of the pattern before prices can resume their uptrend for a double bottom, or before prices can resume their downtrend for a double top pattern. So they are all also reversal pattern, but a bit different from the head and shoulders, but it's approximately the same thing. If we are talking about psychology of the market, it's the same psychology for double bottom, double top than for the head and shoulders. Just a word on volumes, because volumes are very important also for the double bottom or the double top pattern. So volume are higher on the first bottom or the first top than the second one. So as you can see in this example, volume are higher on the first bottom and lower on the second bottom. And then volume are increasing when prices escape from the pattern, when prices break above the neckline for a double bottom pattern, or break below the neckline for the double top pattern. Regarding targets now, regarding targets and risk reward and money management. So the minimum measuring target is the 8 of the top. Projected upward from the breakdown from the breakup point. So on this example, you can find the target. You can see the vertical distance reported upward from the breaking of the neckline, and you can find your target. So in terms of money management, how to trade the double top or the double bottom pattern, the best things, I think, to avoid some pullback and to avoid to be stopped out at the bottom of the market is to put your stop loss half of the pattern. So in the middle of the pattern, you can try to put sometimes intermediary support threshold. Sometimes it's better to put your stop loss at the previous bottom, but you will have a lower risk to reward ratio. So it's up to you. If you want to put your stop loss at the bottom of the pattern, if you have a target, if you choose for target the measuring move and the theoretical target of the pattern, you will have a risk reward ratio about 1 for 1. So it's not very interesting for trading, but sometimes some investors prefer to take more risk and to have a stop loss maybe a bit far away, but to be sure not to be stopped out at the bottom of the market. But to be honest, I would recommend to put your stop loss half of the pattern. I think it's enough. But be careful, you have to clearly validate the pattern before you see the pullback. You have to wait for a daily or a weekly close above the neckline before saying, okay, the pattern is validated, to avoid any false upward breakout or false downward breakout. So if you can identify clearly the breakout, then you can put your stop loss half of the pattern. And the target will be, as I explained, the vertical distance projected from the breaking of the neckline. Okay, then let's see this example of the Canadian dollar, Forex, a bit of Forex. So you can see on this chart the huge downward trend. You can see the formation of the double bottom pattern, so the first bottom and the second bottom. This is Forex, I don't have volume. and you can see the validation of the pattern and the target of the pattern. You can see on this candle, this one, you can see a pullback, an intraday pullback, because this is a daily chart. So one bar represents 1 day of trading. So you can see that we have seen a huge intraday pullback towards the neckline of the pattern. So it could have been a very interesting trading idea for investor when you have this kind of pullback on intraday and a huge technical rebound then, and we close far away from the neckline. Then you have your bullish signal, and then you can enter your trade with a stop loss approximately below this candle and a target just right there. Of course, it doesn't mean when prices have reached the target, the theoretical target of the pattern, it doesn't mean that the bullish trend is over, but it means that you can take, considering taking profits. But sometimes you can see other bullish elements which allow you to think that prices will continue to go higher. So it's not, an obligation. You don't have to close your position and to take your profit when prices have reached the theoretical target of the pattern. We recommend to take your profit, at least half your profit, when prices reach the target. But sometimes you can choose to raise your stop loss and to keep your position alive. You have other money management solution when you are in position, but it's not the purpose of this webinar. But maybe in another webinar we will speak about a bit more deeply the money management. But regarding patterns and how to trade them, you can easily use the double bottom pattern to set up trading plans and to find some targets. Okay, a word now on the rising and falling wedge patterns. So I will be quick because it's not these patterns. Those patterns are considered less powerful reversal pattern than the head and shoulders or the double top or double bottom pattern. But just a quick, just a few words on this pattern. So sorry. So the rising wedge, this one is a bearish pattern that begins wide at the bottom, that begins wide at the bottom and contracts as prices move higher and the trading range narrows. So rising wedge are bearish and falling wedge are bullish. So you have to see previous uptrend for the rising wedge pattern. So you can see the previous uptrend, and you have to identify a previous downtrend for the falling wedge pattern. How to trade the pattern? Yeah, about volume. So the pattern, the rising wedge pattern, is validated when prices break below the ascending trend line, the lower ascending trend line, right there. Always check volume when you can. The breakout has to do with an increasing volume on the same day, and it's the same thing for the falling wedge pattern. Decreasing volume during the formation of the pattern. When the pattern is taking shape, volume are decreasing, and when we validate the pattern, prices, volume are strongly increasing. So that's how to trade the rising and falling wedge pattern. It's quite the same rule, and it's very interesting because you can find easily the stop loss thanks to rising wedge or falling wedge pattern. The stop loss has to be put above the last bullish acceleration, the last up move, and the measure move target, the theoretical target of the pattern, is the first bottom of the pattern. So you can see that in terms of risk to reward ratio, these patterns are not very interesting, but it could be useful to at least take profit. For example, if you are bullish in a bullish trend, you still hold your position, you stick with it. When you see the validation of the rising wedge pattern, you can see, okay, no, we have a downward potential toward at least a theoretical target at the bottom, so I can choose to take profit, close my position, or I can choose to open and reverse my position or open short position with a stop loss above the wedged high, so the previous stop. And it's the contrary for the falling wedge pattern. You put your stop loss below the wedge low and you have a target around the first basis of around the wedge basis. So the first up move, the first technical rebound on the falling wedge. So this is a theoretical target of the pattern. You can see it within an example. This is euro dollar. So you see at the end of 2014 we were in a bullish trend, as you can see, but prices validate the rising wedge pattern. So the theoretical target was 133, just right there. This is the dotted line in blue. So we can expect, when we validate the pattern, that's right there, you can expect a decrease towards the 133. But we cannot say at this time that the trend is strongly reversing downward. But we can say, okay, maybe it's not, it's just a consolidation towards the basis of the pattern, of the wedge pattern, toward 133. But at least you can say, when you're there, if you are bullish, you can say, okay, no, the bearish risk is increasing, so I can close my long position, or I can choose to play the bearish movement and to say, okay, I'm expecting at least a bearish move toward 133, so I can try to open a short position with a stop loss above the previous stop and a target at 133. We can see in this example that the rising wedge pattern was a reversal pattern because prices continued to go strongly downward, but the theoretical target of the pattern was 1.33. So rising wedge pattern could be also strong reversal pattern, even if it's less powerful than head and shoulders in terms of probability. It's less powerful than head and shoulders or double top or double bottom pattern. But it could be very useful for investors, for you, when you want to manage your position or when you want to open a position. Okay, so now we have discussed the most commonly used major reversal patterns. These patterns signal important trend reversals in progress. And as I explained at the beginning of the webinar, this presentation, there is another class of pattern called continuation pattern. So let's have a look now of this type of pattern. We are about to speak about triangles, flag, and pennant. So these patterns globally indicate that the sideways price action on the chart is nothing more than a pause in the prevailing trend, and that the next move will be in the same direction as the trend preceded the formation. So that's very important to keep in mind that all these patterns, triangle, flag, or pennant, are continuation trend pattern. So it's nothing more than a pause within the bullish or the bearish trend. So it's very interesting for traders to enter a position thanks to the validation of this kind of pattern. So let's start with the triangles. There are three types of triangle: ascending, symmetrical, and descending triangle. So the symmetrical triangle shows two converging lines, the upper line descending and the lower line ascending. And the vertical line measuring the height of the pattern is called the base. So this vertical line is called the base of the pattern. You can see ascending triangle, so it's quite obvious on this chart. You have an ascending trend line and you have an horizontal upper boundary, and you have the descending triangle with an horizontal lower boundary and a declining upper boundary. Be careful with triangle because you have to wait the validation of the triangle. Don't try to anticipate the breakout of the triangle because in terms of probability, triangle can also be reversal pattern. So it could be very dangerous to anticipate the validation of the pattern, especially for triangle, because especially for symmetrical triangle, because this kind of pattern, in terms of probability, you have a huge also probability that prices break below the lower ascending trend line. So always wait for the validation of the pattern of the triangle. Don't try to enter position when you are in the triangle, when you are consolidating, when prices are consolidating within the triangle. Don't try to anticipate because, yeah, as I said, the probability of a downward breakout is quite important. So wait for a breakout, upper or a lower downward breakout of trend line. Just a word about on volume. It's always the same story. The volume are decreasing during the formation of the pattern and increasing when prices validate the pattern. When prices break above the ascending triangle, break above the horizontal trend line, break above the descending trend line on the symmetrical triangle or the ascending trend line, and break below the horizontal support, the horizontal trend line on the descending triangle. So always have a look when you can on volume, and volume must confirm the validation of that if you want the pattern to be trusted. In terms of the money management and risk reward, it's quite easy to trade some triangle, especially ascending. You have to, the best things to do is to put your stop loss below the last consolidation move. So the stop loss so has to put on the dotted red line, so below the last partial decrease. And the theoretical target on the pattern, the first target could be set projecting the base of the pattern. So what I call the base, this is this vertical distance projected from the validation of the pattern, projected from the breakout of the horizontal trend line. And you can find a first target. The second one could be set reporting the flagpole, what we call the flagpole, which is the previous bullish trend, the previous bullish acceleration reported from the validation of the pattern from the breakout of the trend line, either for the ascending triangle or for the symmetrical triangle, and also for the descending triangle. Always the same story. So the stop loss just below the partial decrease also for the symmetrical triangle, and above the last partial increase for the descending triangle, and then you can report the base of the pattern and the last bullish acceleration, which is called the flagpole, to find some targets. Let's see this with an example on USD GPY. So you can see the base of the pattern. In this example, this is a triangle, and I wanted to show you this pattern, this example, because I wanted to show you that triangle pattern. You have to be careful, because that's why I was saying that you don't have to enter a position before the pattern is validated. Because in this example, you can see this beautiful triangle pattern. But with the previous downward trend, you can say, okay, there is a higher probability for a downward breakout of the pattern. Downward breakout of the rising trend line, and then prices can resume downtrend. But you don't have to anticipate, because in this case, prices validated the triangle, the symmetrical triangle, thanks to the upside breakout of the declining trend line. So it was finally a bullish signal, a reversal signal. In this case, you can find some theoretical targets, you can find a stop loss, you can put your stop loss below the last partial decrease, so just right there on the arrow, with a target around there. And you can see that prices, investors took some profit around the theoretical target of the pattern. So it was very interesting. I think that's it. I was thinking about, I just wanted to add that you can see with this kind of pattern, you have a very interesting risk to reward ratio, because with the stop loss right there, and if you buy this pair, the USD GPY, the Japanese yen, thanks to the validation of the pattern with a stop loss below the last partial decrease, and the target around 119, you have a very interesting risk to reward ratio. So in terms of money management, it's very interesting for investors. Okay, let's talk now about pennant and flag. So the flag and the pennant are quite common. They are very similar in appearance and have the same volume and measuring criteria. So these two patterns represent brief pauses in a dynamic market move. So you have to see one of the requirements for this pattern is that you have to see a huge, a sharp straight line move before the pattern. So you can see this strong bullish acceleration for the flag pattern and this strong bullish acceleration for the pennant pattern. And so all the flag and the pennant pattern has to be preceded by a sharp straight line move. That's very important, because it is only brief pauses within a dynamic market. So prices has to resume their uptrend or downtrend, but is in this example uptrend, prices are likely to resume their uptrend very quickly. So this is only brief pauses within the bullish trend. In terms of trading, after saying just a word on the volume, always the same thing. You have increasing volume when prices escape from the flag pattern, when prices validate the flag pattern. Decreasing volume, it's always the same one. Decreasing volume when the prices are shaping the pattern, and increasing volume when prices break above the pattern, escape from the pattern, and validate the pattern. So also for pennant, it's the same thing. Decreasing volume during the formation of the pattern, and increasing volume thanks to the validation. How to trade them? It's almost the same thing that I explained previously. It's about the flagpole. What I call the flagpole as this bullish acceleration. So you have to report, to project the flagpole from validation of the pattern. So from the breakout of the descending trend line, you have to report the flagpole, and you can find a minimum price objective. And also for the pennant, you report the flagpole from the validation of the pattern, from the breakout of the pennant, and you can find the minimum price objective. Let's just see this thing with an example, the flag pattern on the cable. Very interesting. You can see here the flag pattern that took shape. You can see the previous up move between there and there. So what is the objective of the pattern? You can say, just thanks to the validation, just here, you can find a trading plan with a stop loss below the last bearish, the last partial decrease, so around there on 166. Stop loss have to have to be there thanks to validation of the pattern. The first target, you can report and project the height of the pattern from the validation of the pattern. And the theoretical target of this flag pattern would have been the flagpole reported, projected from the validation of the pattern, which has been 170, around 170, 171, 172, was exactly 172.09 on this example. And then you can see that investor took profit and prices turned down dramatically on this pair. So you can use patterns, and in this example you can use a flag pattern to set up, to find a trade ID when the pattern is validated, the stop loss around the previous bottom and the target 172. You can use this pattern to find some target, as I explained, and you can also use this pattern to say when prices reach the target, okay, now prices have reached the theoretical target of the measure up move, let's take profit and let's see what happens if we can identify some other continuation pattern. And we can see in this example that we cannot identify any other continuation pattern and prices turn down, turn down, turn down. Okay, so what can we say? Patterns, to sum up, are the most powerful tool to detect psychology of market. So that's very interesting for all investors, for all traders. So thanks to chart pattern, you can better find trading IDs, as we have just seen on the market, and set up trading plans with stop losses and targets. And also you can find trading IDs with good risk-to-reward ratio, which is very important, which is crucial for investors who want to survive in financial markets. Patterns, as I explained during this webinar, patterns have to be combined with volume when you can, except on Forex, but don't forget to check the volumes. Volumes plays really an important confirming role of the pattern. And the pattern cannot be trusted if you cannot confirm with volume. And finally, as I explained, patterns allow building trading strategy with relevant money management and risk reward. Okay, so that's it for this webinar. It's time now for a question and answer. So don't hesitate, if you have questions, to ask me your question now. I can explain a bit more some patterns if you want. We can speak about the market. It's up to you. So don't hesitate to ask me all your questions right now, and I will do my best to give you an accurate answer.
Hi, I'm just going to jump in here for a second. Somebody asked about the webinar being emailed. We've recorded the whole thing, so we will send all the attendees the recording after we've completed. If anybody has any questions, there's a chat box at the bottom of the screen on your right. You can ask any questions here, and Nicholas will answer them for you.
Yeah, what is very important to keep in mind is that pattern can be very, very powerful for you to anticipate reversal, downtrend or trend. Or for example, as I gave you some example, for example, on the euro dollar with rising wedge pattern, which was in this example a huge bearish signal for the euro dollar. So yeah, all the patterns we mentioned today are very important for investors and for traders. When you want to invest in the financial markets, it's very important to keep this in mind. So I cannot see your question, so maybe so.
Hey, I think there's a small technical issue.
You can,
yeah, I'll read you the questions that are coming through. So the first one is, what is the relation between Trading Central and ICM Capital?
Well, we are a technical analysis provider, so we provide some technical analysis from intraday to swing trading and long-term investments with ICM. Yeah, this is a partnership, and we provide all the technical analysis stuff to ICM.
And the market report.
I can see one question. Is it possible? Yeah, is it possible to identify patterns on MT4 using same tool? I think so. To be honest, I don't really know MT4, but I think you can identify patterns on all the software. So of course, you just have to see the chart, to have the chart and the volume. So historical data, chart and volume, and you can identify the pattern. So yes, you can do this. If you want to send me a question, don't forget to choose to send the question to the organizer.
Did you see the question about what's the ratio to risk reward?
No, I didn't see it. So the question is, what's the ratio?
For risk reward, is it 1 to 3?
Yeah. So regarding the risk reward ratio, the best things to do is to have at least 1 to 2, but 1 to 3 is better.
Okay, are there any more questions from anybody else before we end?
Yeah, maybe just a word on the risk-reward ratio. So that's why patterns are very interesting, because with this kind of pattern, you can easily have an interesting risk-to-reward ratio. I don't know if I take for this example, whatever. Let's take the Canadian dollar. You can see on this chart that with a stop loss just right there and the target, you can easily have an interesting, a good risk to reward ratio. So 1 to 2 is the minimum, 1 to 3 is the best. Usually I would say if you trade forex market, 1 to 3 is great. If you trade stocks, 1 to 2 is enough, because it's a bit difficult to have 1 to 3 risk to reward ratio on stocks. It's a bit much more difficult. So 1 to 2 is great. 1 to for stocks, and 1, 2, 3 is better for Forex and the commodity market. Yeah, you cannot see, I can see some question about volume. Yeah, you cannot check volume as I explained on the Forex market. So that's too bad, but we have to do without. So you have to trust the pattern without volume. You cannot check it. So if you can identify some reversal pattern or continuation trend pattern, you have to trust the pattern without the volume. That's too bad, but we cannot do anything. So yeah, don't check the pattern. Don't check the volume on the Forex. You can't, but you can also identify the pattern, the reversal, the head and shoulders, or the double bottom, etc. So except for the Forex market, you have to check volumes. But for the Forex market, forget about it. You cannot check it, but you can anyway check if you can identify some pattern. Okay, so thank you everyone, and speak soon for another webinar.
Thank you, Nicolas. That was great. That was very interesting. So we're going to email everybody the recording of this, and please get in touch on analysis@icmcapital.co.uk with any questions, and we'll let you know when we have the next webinar. Thank you very much.
Thank you. Bye bye.
Bye bye.